Hello, and welcome back to our viewers. Today we're talking about some eyebrow-raising comments delivered by the Federal Reserve's Jerome Powell regarding the commercial banking crisis and potential impacts to precious metals. Stay tuned. Before we begin, please take a moment to like and subscribe. Thank you. Today's update is all about banks. For those who don't remember or didn't know, there was a big run on banks starting March of 2023 due to a bank failure at Silicon Valley Bank. There was a bit of a domino effect, and other banks subsequently failed, some of them quite large. Credit Suisse was a huge bank taken down due to contagion, for example. Now, the Federal Reserve stepped in and launched the BTFP, or Bank Term Funding Plan. This kept U.S. banks solvent and reassured bank customers they would be able to get their money out from the bank if they went to withdraw. A number of customers moved money around in the aftermath, but the BTFP was successful in stemming the tide, and the bank failures largely ended as consumers stopped panicking. This also spurred a huge flight to metal, and the price of gold and silver rocketed upwards and led to one of the most prolonged surges in retail precious metal demand that we've ever seen. Now the question is, will it happen again? To fight inflation, the Fed raised interest rates, and at the same time, commercial real estate has plunged in value as the work-from-home trend cleared out downtown high-rises in a post-pandemic era. This has put banks who were overexposed to commercial real estate in a difficult position, as many are upside down on their investments in commercial real estate, but also in treasuries and mortgage securities. Well, these unrealized losses can be waited out with enough time, but if enough bank customers come to withdraw, then banks have to sell those assets at a loss to cover the withdrawal. And that's what happened to Silicon Valley Bank, and it's how bank failures can occur. The FDIC released fourth quarter 2023 results on March 7. There was a lot to unpack there, but we're going to show a couple of charts. And the first one shows unrealized gains and losses on investment securities. You look at the unrealized losses our banks are carrying, and they are worse than 2008. The total unrealized losses were sitting at $477.6 billion in Q4. During the Great Recession, unrealized losses were less than $100 billion. So there is tremendous risk here if banks are forced to sell assets at a loss to cover withdrawals. The second chart shows past due and non-accrual rates by asset size, and this shows that large banks are deteriorating. The volume of past due and non-accrual, non-owner-occupied commercial real estate loans increased by $2.3 billion quarter over quarter. Now, per the FDIC report, deterioration is concentrated in the largest banks, which reported a past due and non-accrual rate of 4.11%, well above the rate of 1.71% for the industry as a whole. Shifting focus a little bit, Jerome Powell stood before a congressional House panel and told them there will be bank failures due to losses from commercial real estate loans. However, he felt confident they won't pose a risk to the entire system, and it won't be the big banks that go down. This has been echoed by Treasury Secretary Janet Yellen, who made similar statements last month. FDIC data mostly corroborates this view. It does seem the overall financial system is healthy enough to withstand some bank failures, but we do find that large banks are increasingly delinquent on CRE loans. This indicates to us that perhaps there is a little more risk to larger banks than Yellen or Powell are willing to admit. The FDIC report does not indicate which banks are delinquent, so it's hard to say. A larger risk to the banking system would be if bank failures precipitated bank runs. And this would be a reason that Yellen and Powell might downplay risk to the systemically important banks in public forums. Now, for a precious metal buyer, we can look at these future events from two angles. First, we expect bank failures to occur. We have very reliable industry experts warning us they will happen. In the past, bank failures have spurred metal buying and increased metal prices. Now, the second angle is whether or not bank runs occur in response to the impending failures. Now, if bank runs occur, then we'd expect a larger impact on the precious metal industry. Last March, bank runs from SVB's collapse caused precious metal buying that led to a $200 per ounce increase in the price of gold. It's over 10%. Now, subsequent bank failures did cause some additional buying and price movements, but nothing on the same scale as the initial shock. And that leads us to our final insight, which is if people are expecting bank failures, then any impact on precious metals or the larger financial system may be muted. This is kind of a best case scenario where the negative impact to people just isn't felt as strongly. That's all we have for you today. Thanks for watching, and we'll see you next time.